Welcome to Gold Silver Pros.
Hey everyone, this is Rob Keens with 𝑔oldsilverpros.com. It is Tuesday, January 23rd, 2024. I got to get used to saying 2024 in the new year. This is the weekly market wrap-up for the channel. We've got quite a bit to talk about. A lot of things happening with bond rates, cryptos, a little bit with gold. We'll get into our deep dive on gold here at the end. A couple of interesting stories for you, but mostly just looking at what's going on in the economy. I think there's some interesting things there. They're kind of flying under the radar, and we'll talk about those. So this is going to be a bit of a shorter broadcast than last week, where I packed a lot in because of what's happening. But there is some really good information, particularly around what happened to gold and silver. I'm going to spend some time going through the COT report and the positioning of traders on that American market and explain to you why prices are going up and down, and follow up on what I said last week, which was what was likely to happen and did happen in the COT report. So we'll go through that for those of you that like to follow that. And for those of you new, what I do on these is in the second half, I spend a lot of time on gold, silver, and tell you exactly why the price is moving. That way you can understand it. It tends to reduce a lot of the anger, frustration, fear, or unknown for a lot of people to go through that. So without further ado, here we go. Looking at bond rates, they have risen. We had both the 2-year and the 10-year benchmark rates, or well-known rates, if you will, fall to about 4%. The 2-year is now back up at 4.402 at time of reporting, and the 10-year at 4.147. Now the 2-year is still trading higher than the 10, so we're still in a yield curve inversion, although that gap between the 2 and 10 has shrunk. They're a lot closer to each other now. You're still seeing more risk in the near term than the long term, according to the bond market. So as an indicator of an oncoming recession, we'll get into another leading indicator, or a bunch of leading indicators that indicate we should be in recession right now, calling into question, what the official numbers on the economy from the governments are actually telling us. So bond rates are up, risk is up in the new year. I expected it would be. I think there's a little bit of a euphoria at the end of every year as retail sales go up for the Christmas season. Everybody's happy. But then you get that splash of cold water on the face after you get through New Year's, and we get back down to what's really going on. And the bond rates are indicating that risk is more elevated than we anticipated. Bitcoin right now is down about $750 to 39,417.21. I think it reached a high somewhere around 48.49 in the past couple of weeks, if I remember. So it's come down about 9,000. The rest of the crypto complex looks red. I don't see anything green on the chart I'm looking at. So cryptos are kind of taking a bit of a bath there as well. The stock markets are down a little bit on earnings reports. We'll get into that. So the article here from CNBC, Dow slips 150 points after a batch of disappointing earnings. It fell Tuesday from record-breaking highs. So the Dow had reached record-breaking highs again on euphoria, something great's going to happen. And then the actual data comes in and it falls back down. So it lost 160 points in the morning today, retreating below the 38,000 level that was crossed for the first time ever on Monday. The 30 stock benchmark was pressured by a 10% decline in 3M, which is one of the big fallers, and which had the worst earning reports in 5 years. And it was under pressure on the back of disappointing guidance. Johnson & Johnson fell more than 1% after reporting earnings. D.R. Horton dropped more than 8% as a home builder missed Wall Street's consensus forecast for per share earnings. General Electric slipped 1% on the back of weaker than expected guidance, which basically means they're saying going forward that they expect General Electric maybe not to have, the next quarter will not be a banner quarter. On the other hand, we had some risers. United Airlines rose more than 6% after reporting strong fourth quarter results, and air travel seems to be making a bit of a recovery the last 6 months. So that's one area of the economy that's doing okay. Boeing's 737 MAX 9 airplanes, though, is causing the airline industry some trouble because of that, them having to ground a bunch of their fleet due to, the door and the issue with the door coming off during the flight. American Airlines, Southwest Airlines, and Alaska Air Group rounding out the airlines climbed at 3%, while Delta Airlines added 2%. So the air travel industry is making a bit of recovery. It's not back to where it was pre-COVID, but it has started to get back up to where it was. So that's a good thing. The S&P 500 officially reached bull market territory, topping its previous intraday high. So again, investors are thinking things are great, but the earnings aren't really supporting that. So it'll be interesting to see over the next quarter how the corporate sector does. NVIDIA did pretty well. There are some areas that aren't doing quite as much. Oil prices are basically flat. earnings is causing a divergence among Dow members. So the Dow fell more than 100 points. 3M dragged it down. Johnson & Johnson went down. But Verizon, Procter & Gamble did pretty good on better earnings reports. So a little bit of a mix here in terms of the earnings reports for corporates. Overall, though, the stock market falling because a little bit more negative news than positive news. And the negative news that we have is a little bit worse than the positive news that we're getting is positive. The Richmond Fed manufacturing sees a decline in January. That's on the heels of the Empire Fed up in the New York Northeast area, just really getting gobsmacked. Manufacturing is down across the economy. Wolf Research, an analyst firm, doesn't believe that we're headed back to a recovery. They still see some recessionary signs. So they're, in their opinion, we're not out of the woods yet. And I would say we're probably headed more for a fall. And I think there are some false positives in the economy based on some bad data, but also based on euphoric expectations at the end of the year. I think we come back down to earth this quarter, beginning of 2024, as we start to get some more of this data in. There's a lot more there basically to talk about, but I wanted to move over into two of the big stories. One, existing home sales fell from 3.82 million last month to 3.78. Housing starts and building permits are about even. One's up, one's down. But overall, the housing market looks like it's kind of peaked out a little bit, and the home sales are starting to come off a little bit because of higher interest rates and also higher prices. I wanted to show you, we're going to do a share screen here on what's going on with leading economic indicators, which is an index a lot of economists follow to see what is going on in the economy. So they grouped a bunch of economic indicators that are important together in an index, and it's fallen for 21 straight months. So we're going to dive right into that now, and I'm going to show you that. So I'm here at the conference board, which puts this out. They had a nice little press release here yesterday on the 22nd about what's going on. And we're just going to show you what's going on right here. As you can see, the annual growth rate of this index relied on by economists across the economy, across the United States, is negative. And the annual growth rate remains deeply negative. So we are not growing when measured on an annual basis. So 2023 and into 2024 is negative, negative, negative based upon this collection of different economic indicators. As we break it down a little bit, here's a nice little graph. We can see that the overall change was negative 2.9%. Financial components are down 0.6%. Credit is down. S&P is up a bit. And that's where you see the stock market being up, even though the economic indicators are down. So I don't see the stock market as being an indication of the health of the economy itself. It's a health of where traders maybe want the economy to go. But I think that stock market is going to come back down this year because you can see the indicators holding up the economy for which the companies, depend upon and the share prices depend upon is not doing so well. So it's hard to say that corporates are going to do great when the economy overall is crashing. Now, a part of this story is that corporates are sitting on a lot of cash. It's because they've cut costs and cut jobs, and we've seen that in the jobs report. So they've cut a lot, and so it's a little bit, they're doing okay in terms of earnings, but with the economy trending down, at some point, they're not going to be able to cut as much, and it's going to catch up with them. And I think that's where we are right now. A little bit of a false view on the economy because share prices are up, but they're up based on cuts, which are going to be felt later as consumers don't have money to spend. And we're seeing that in the underlying economic data. We can see here that non-financial components fell the most, negative 1.9, and some others did okay. But overall, the economy is not doing so hot. This chart is, despite a recent upswing in its 6-month growth rate, the U.S. LEI continues to signal a recession. So recession indicators here in red, we fell below that. In net 21 months, it's been down straight 21 months. So that's not great for economic indicators. And I think that is yet another, along with the yield curve inversion and a lot of other statistics, the decline in full-time employment versus part-time employment. A lot of other indicators are showing that we're headed into recession, if not in one already. And when you're down 21 straight months on leading economic indicators, you have to ask why is the government not calling it a recession right now? Anyway, going over to the gold and silver market, we're going to do this kind of quick today. I just kind of wanted to do an update over what we saw last week. I took a big deep dive into this. Trade is falling and gold price has risen. Gold's up a little bit today. And that's the pattern. When you see the amount of open interest fall, it usually means you're going to get a rise in the gold price. There's not as much shorting going on. And that pattern seems to have held. As of about 9 a.m. this morning. This is the data that we're getting, 166, I'm sorry, contracts trading in February, but April now is the bigger month as we see the 233,000 contracts. So we'll concentrate on April, but you got two future months going on that have a fair amount of trades. We're going to look at both of them. There is an astounding amount of EFPs. This is the thing that really sticks out to you in the gold market. 15,584 in a day, 9,584 in February, and 6,000 in April. What the hell is an EFP? So I'm gonna blow this up a little bit so you can read what an EFP is. It's an exchange for physical. As you can see right here in this little dialog box, an exchange for physical trade is a privately negotiated and simultaneous exchange of a futures position for a cash position. Well, expanding upon that, the cash market's over in London. So you're moving over to a different market. So you're exchanging something in the COMEX for something in the London market, or the UK market, if you will. And what they're doing is they're saying, this is a futures position, this is derivative, it may not have any physical delivery associated with it, but we're going to go to a cash position or a physical position over in this other market, because the UK market is, over the counter. You're either trading price movements or you're actually going for the gold itself. And that means, to me, there are a lot of contracts hunting for gold. And it also means, to me, actual physical gold, but also means that prices are too low here. A lot of times when you see such a huge number like this, which is about 3 times normal in a single day, what you're looking at is people are saying gold is not priced correctly here and needs to be priced higher. So they're moving that to another exchange to see if they can get better pricing. And it means that the prices really are much lower here in America than they are other places. And first of all, you're just going to try to get your higher price and make your money on the contract, but you also may want to exchange it for actual gold, because they do that over in the UK market. So that's really an astounding number, and that's just one day's worth of data. We go back to Friday, we also had pretty good EFPs. We had 5,000, as you can see here on the February contract. And then as you go to Thursday, we had 2632. But having all of this, in Monday's data, 15,000 is quite a few. So people are hunting for higher gold prices and for gold itself. And that basically tells you the COMEX is mispriced. It's not priced comparatively to where the rest of the world's priced. And it seems to me that the Shanghai market in particular, but also the London market, where that EFP mechanism works, where you're trading, both of those markets are pricing their gold higher than what you're pricing, in the COMEX. And it just goes to show that the COMEX is probably a bit more bearish on gold than the rest of the world. And that's because there's been a lot of short contract paper dumped in that market as of late, which we went over last week. All right, now on the settlement data, looking at it as of about 10:32 p.m. last night, so this is yesterday's data. You can see that gold's trading down about $7 on Monday. On Friday, it was up about $7, and Monday and Friday are just basically a flip of each other. It was up $15 on Thursday. On Wednesday, it was down 23, and on Tuesday, it was down 21. So overall, in the last week, gold has been down, but it's had a little bit of a rise, and I'm going to show you how that rise occurred when we get to the COT report. I also wanted to get into as well what's going on in the actual gold physical trade. I said last week when I did this that there was one day about 877,000 ounces came off of registered, actually came out of registered, and those were either warehouse deliveries or physical deliveries coming off the market. And we can see on this change, that was the largest I've ever seen in one day. And that video I put that video on Twitter, that little clip about the largest, amount taken out of registered inventories in COMEX ever. And we've had a lot of views on that. That was very substantive. A lot of people felt that was important, and I did too. And overall, we're seeing gold still come off the exchange. So that's what I want to focus on. This chart down here, this total all ounces that I'm looking at here at the bottom, gold's been coming off. There was a little bit of a spike in 2021, 22, but really net, we've lost a lot of gold ounces, something like, is that thousands of ounces? So you're looking at 40 million ounces have come out. That's quite a bit. Is that really 40,000 ounces? That's a lot. Well, anyway, a lot of ounces have come off, and it'd be 40 million. So in the last 3 years. And so the trend has been for gold to come out of the exchange. Why is it coming out of the exchange? Well, I just got through telling you that with all of these EFPs, that people are hunting for better gold prices and actually physical gold. One, there's probably not enough deliverable gold for all the contracts that want it. But two, the prices are too low. And because the prices are too low and people are moving to other markets, people are coming to basically take it off the exchange for a discount. That's basically how that works. Same thing with silver. We'll get into that as well. Silver, you know, there's some exchange for physicals here as well. Go on silver market, and these are 5,000 ounce contracts, so it's actually quite a bit. The gold contracts are 100 ounce, but the silvers are 5,000 ounce. There's a lot being taken off in silver as well. The same pattern is there in silver from people saying silver's not priced appropriately. We're going to go to one of these other markets, and we're going to get better pricing and maybe actually get access to that physical. So you look in silver, the big contract month is March, but you see some demand building up for May as well. But March really is the big one. It had 105,000 contracts. May, you know, has 19,000. A couple other months have a few, but March is really the big one. So that's the one we'll look at. Some EFPs on Monday, 1710, as you can see there. So we come down here to Friday's data, 340. So a little bit less in silver, but still the same overall trend that people are looking for better pricing elsewhere, and the physical metal. As we look at the data, up 16 cents. So far on Tuesday. This is Tuesday's data. So today's data, early preliminary trading as of about, looks like 12:31 Central Time. As we can see here, silver's up about 16 cents. Nice little rise there. Monday, silver was down 41 cents. And usually that happens because in the after-hour trading on Sunday and early trading on Monday, you get a little bit more of that international trade coming in, and then it got slammed down on Monday. So it was a Monday slam down. On Friday, down 98 cents. Heading into the weekend, and Thursday up 14 cents, and Wednesday down 42. So overall, silver's come down not quite a buck in the last week, but it's been a little weak, whereas gold has had a tad more strength. In other words, I would say that those are basically sideways trading markets. But as I get in the COT report, I'll explain who's moving those, pushing those markets around, and it's done with the paper. It's not physical trades, the paper. We do go to the physical, however, here on the Gold Charts RS chart. Thank you, Gold Charts RS, for providing this for us. We're looking at physical depositories across the world. Of course, we've got the COMEX in the top line here. And then we have the rest of the Western world, most of the rest of the Western world, a lot of the ETF funds that are Europe, America, a lot of it in the UK as well. And you can see that silver's been flowing off as well. Net overall, though, there's actually been more silver ounces flowing back in to the exchanges. A lot of that has to do with ETFs. When people buy shares on the ETF, and you can see like iShares right now, there's a lot of retail investment coming into iShares, and what they're having to do is put more ounces into the depository. So you've seen a little slight uptick, is a baby uptick down here on this big total all ounces chart. It's this little baby little tick right here up in the last few months. That's the retail investment coming into SLV, and that's a little bit of investment or a little bit of metal also coming onto the COMEX. It's nowhere near the amount that's flowed off the last 3 years since silver squeeze. I mean, there's been millions of ounces of silver flowing off, but we had a little uptick. Why? It's mostly retail with a little bit of industrial at the same time, demanding more silver. Now, in industrial, a lot of this is going to be coming from sources including mining and stuff like that. Most of the sources going to SLV and the ETFs aren't mining; they're actually minted ounces, so they would come off either the COMEX exchange or private mints, that type of thing. But overall, retail is strong in silver, and that's a good sign for silver. Even though prices are down, retail demand is strong, and that tells me heading into the year, people are starting to get back in to that physical silver trade, even though the prices are being smashed with the paper, if that makes sense. So that's kind of where we are in silver. All right, now we're going to look at the COT report. It's going to be the last part of the presentation here on gold and silver. We're focusing on silver. This is the table as of January 16th. Yes, the data is old. That's how it works. The CFTC puts it out in arrears or after the fact, if you will. But looking at the price movements, you saw silver rise a bit. That rise that we saw was a cancellation of some short contracts, but then you saw it come right back down, and silver net lost. Why did silver net lose? Because the bullion banks dropped positions on both sides. So that allowed silver to kind of range trade a little bit because they're really controlling the price. So the X factor there. The managed money added some shorts, took the other side of the trade, and then the other reportables took the longs, and the swamp dealers basically just got rid of their contracts. That allowed silver to fade a little bit. Moving over to gold, this is gold as of January 16th. You're looking at the chart here in blue. We look at what the swamp dealers did. They dropped more shorts than longs, and that's why gold went up. Gold in the last week's gone up about 30 bucks. Silver net's gone up just a few cents. And you see why gold's gone up more, because the swamp dealers dropped more shorts, meaning they released that short pressure. They got rid of those short contracts, net of about 6,000. So they dropped some longs, they dropped more shorts. They're dropping their overall exposure to the market, but because they dropped more of the short side, then what you're seeing there is allowing that gold price to rise at $30 like we have seen. So that basically sums up what's going on in the gold market. Shown it 100 times. The derivative prices pushes around the physical. Physicals, because the prices are weaker over here in the United States and other parts of the world, you're starting to see people get into contracts over here and move them over to see if they can get better prices elsewhere. We also see gold flowing off of the COMEX, presumably east into these other markets as well. And that pattern has been going on for about 3 years. Of course, the overall control of the market's been going on since the 70s when the commodities markets were developed and a lot of that paper came in. And the question I really have is, how long is this going to continue? It's obvious that there's more metal coming off of the worldwide stocks faster than we can produce it through the mines, so that prices should be slowly going up. But every time we get a nice price rise in gold and silver, it comes right back down. A lot of that paper on the derivative market, at some point, that's got to break. And it will break, I think, when it gets to the point there's no more metal. And it seems as though if you look at the charts, well, we got enough metal to go another 3 or 4 years, but that's not really the case. Because if we have economic issues, the first part of this presentation, where I talked about the economic issues that aren't supporting share prices in the corporates, they're also not supporting the stocks, bonds, and real estate. People are still invested in those, though, because they're getting a false signal. Oh, stocks, bonds, and real estate are doing great, but the economic fundamentals don't support it. And what happens is when the economy starts to head into that recession, again, looking at the leading economic indicators I focused on today, we've probably been in a recession for quite a while. The government just isn't calling it. But once we get that official call and it's blatantly obvious to everybody, people are going to rush into gold and silver. So tying that into gold and silver markets, that stock's not going to last forever. If you get Joe and Sally down the street investing a little bit of silver and gold, very quickly that demand will overwhelm our stocks. The stocks which have slowly been depleted the last few years by industrial demand and demand from central banks for gold, and in demand for heavy investors in both gold and silver. The retail crowd, in other words, to summarize this for you, the retail crowd's not buying a lot of gold and silver right now relative to other times like 2008 to 2011, 2012. But there is enough buying from other parts of the economy and other players that gold and silver has been drained a lot. So when that retail comes back in the next recession, it's going to drain the remaining stocks pretty quickly. At that point, it'll be blatantly obvious to everybody on the markets that the prices need to rise. And then you're going to get, I think, that last big bull leg in gold and silver before the blow off top, which will probably last a couple of 3 years if history's any indication. I think in 2024, we're headed into that. That's why I've been talking about 2024 being that year of the battle against the longs and the shorts, because the economic data is weakening. Some of these asset classes really aren't supported by that economic data. Consumers are out of money. Eventually, these have to start falling. We've started seeing it again with the corporates and the earnings reports the last 2 quarters, but this quarter especially, the earnings reports aren't supporting all-time high stock prices. The thing that was supporting it was the corporates cutting jobs and cutting costs. Well, now they're not going to be able to cut much more. Yes, AI is playing into that, but at some point, you still have to have employees. And with all those people cut, what's going to happen is consumers were on credit. Remember last month, the last 2 months, we said they're on buy now, pay later, and they had the highest revolving credit ever. The ones that are getting laid off are living on credit. And so there's not going to be as much purchasing. That's going to collapse. So the consumer is going to collapse. The corporates eventually will start headed back south. The stock market will start to come down. All of this comes after the weakening of the fundamentals. The weakening of the fundamentals comes first. Then people run out of savings. Then they live on credit. Then the corporates cut, which they've done, which exacerbates the consumer who no longer has any more savings. And then they run out of credit, and not enough people are employed full-time with benefits. And so the economy starts to retract, and then you get into the big, deep contraction. So I think the last couple of years, we've been living in this slow decline of the consumer, but now the consumer is about to go like that. And that's what the leading economic indicators told us, which is why I put it out on the program. So adding it all up, we're sort of in the calm before the storm. We're in the eye of the storm. We had issues in 2008. We had some issues in 2020. Now we're sitting in the eye of this hurricane, okay? And what's going to happen is when we get to the other side of the eye, as the hurricane moves through and the fundamentals, the technicals are going to start indicating it. People are going to rotate out of these other asset classes into gold and silver. There's going to be a run because the gold and silver stocks have been depleted through industrial demand and central bank demand and big player demand. The small guy's going to get in and not have enough gold and silver. It's going to shoot those prices back up. Then we get that last leg. And yes, this has taken some time. I understand some people get frustrated with the prices, but nothing happens overnight in these big global markets. It takes time, but we're really getting close. You can see it in the data. The economic contraction is coming. The consumer's been tapped out. They're living on credit. That's going to crash. And then at some point in time, the economy's got to go with it. The corporates are going to go with it when they can no longer cut anymore without eating into their own products development. There's not going to be that demand. And then you're going to see the stock crash, and then the bonds will spike up again. The bonds are already up. You already have the yield curve inversion because bonds are smarter than stocks. Bonds will show pressure before stocks do, but then the bonds will start to collapse too because why? So much debt that can't be paid back at higher interest rates, and it's going to collapse that market. And it always goes like this. It always kind of goes up, and then it kind of levels off, and then it goes boom. And we're sort of in this leveling off, sort of tipping over, and then the boom is going to come after. And that's the waterfall, and that happens really fast. And now it's going to surprise a lot of people when it does. The exact date it happens, I don't know, but the data is clearly pointing out that we're headed to that cliff and then over that cliff. It's very clear. There's no way to make up for a dead consumer who doesn't have any money. There's no way that corporates can cut past a certain point to the point that they don't cannibalize their own production and their own efficiency. There's no way to taper over or to paper over higher rates on bonds when those come due. And when all these bonds come due, when the bank term funding program comes due and everybody's got to pay back this debt at higher interest rates, that's when you're going to see that collapse. And I think all of that is starting to occur now. You can see it in the data, and give it a little bit more time, and eventually you're going to hit that waterfall. And that's what everybody's looking for in terms of the obvious. It's not obvious yet to people. We're a little bit of a euphoria stage with the stock market, but that will change. It'll change very quickly. All you have to do is look at 1929, 2007, 2008, 2000 tech crash, 1999, 2000. We all partied like it was 1999, and then we paid the price in 2000. We partied like it was 1999, and we paid the price in 2008 through 2010. We're partying like it's 1999, but we paid the price during 2020 with the shutdowns. We partied like it's 1999, but we're paying the price right now with what's going to be probably the biggest recession in American history coming up in the next few years, more than likely, looking at the data. And I think that does start in 2024. That's why 2024 has been key in sort of my analysis and what's going to happen. You're going to have that choppiness. You're going to have prices move up and down as the longs and shorts fight each other. But once there's no longer the support for the economy, fundamentally, then the shorts are going to win, prices are going to come down, and you're going to see that boom in gold and silver. I think that's where we are. And so that's why I do this weekly market wrap up every week, because I go over the data, 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 I go over the data. This is your splash of cold water. No matter what the media is saying, no matter what these stock and bond indices are doing, you come here to get the data, which is telling you what's going to happen in the future. Because the one thing you can't do is you can't print your way to prosperity. You can't do it. It's never worked. You cannot print fiat money to prosperity. Commodity money has always been the safe haven, and the fundamentals do matter. And that's where we're getting to in this part of the economic cycle. The crash is coming. I fully believe it. And that's why I do the data for you to see. All right, that's going to wrap it up for the weekly market wrap. We do have some specials on gold and silver. I'm going to go over those real quickly for those of you that are interested. All right, you guys have asked for silver to go on sale, so we're putting a little bit of silver on sale. Now, these are limited deals because I have limited stock, but I think they're going to be really good. The first one that I'm going to put up is going to be Geiger. These are Geiger 20-gram bars. They're absolutely beautiful. They're almost like collector's edition. Everything that Geiger puts out is just so gorgeous. They're 20 grams, and I'm doing them for $30 each. 20-gram silver for $30 each on like a special, very limited stock that I have for those. I also have very limited stock of holiday rounds. We're no longer in the holidays, so I'm going to drop these at $23 an ounce. And if you're curious, it has that on the front, a little nutcracker on the front, and then just basically like a little snowflake on the back. They're really cool. They're 1 ounce, $9.99, made by a local refinery. And I'm going to put those for $23 each. Now, I have a very limited supply of these. So the first person that puts in an order is probably going to get them all. But I will put these at $23, which is something like 50 or 60 cents over spot at the time we're recording this on Tuesday, January 23rd, 2024. I've also got basically the equivalent of those snowflake rounds, basically a snowflake on either side. These are 10 ounce, and I'm going to put these for sale for $235. That's about a buck over spot on the silver, $235. I've only got 2 of those, so probably the first person that comes in to buy one of those is going to get them both, I would imagine. It's a very limited supply of what I'm selling this week, but I'm doing some really good deals for you. You can get some cheap silver. Those of you who don't mind the holiday rounds, having in your inventory, if you just want cheap silver, this is a way to do it. This is a closeout deal. I'm going to lose on this. I paid more for these rounds than you're buying them for. Again, 23 bucks even per ounce on these. Limited stock, $2.35 for 10 ounces. That's $23.50 an ounce on the big bars, and then 30 bucks on the Geigers, which have very limited stock. That's a pretty good price as well for those, which are really beautiful bars. That's all I've got for you this week. But as we come across new deals, I'll put those out on the channel for you. Now, to get those deals, what you have to do is go to www.goldsilverpros.com, and you have to fill out the form. You're not going to get these online. If you just go and order off of goldsilverpros.com, you're going to get the full price on those items. I don't want you to do that. So what we're going to do here is show you how you can get the reduced price on those items. You simply go to www.goldsilverpros.com/discounts, or go to www.goldsilverpros.com and click on discounts, and you click on the access discounts here, and it gives you the form. Those of you who followed me know how I do this. I'll call or email you back based upon your contact information, take the order, and it's first come, first serve. I try to reach out to everybody that after I run out and say, hey, I'm out. Sometimes I'm able to do that or not, depending on the response. But if you don't get a response from me, I'm definitely out. And I think the first person to take advantage of each one of these offers is going to get them, because it's limited stock. And then we'll come back next week and we'll have more stock on things. I'm refilling the store. I've got some 2024 Eagles coming in. I've got new Aztec design rounds, 2 new Aztec rounds that are really, really cool. We'll talk about those next week. But for now, that's what we have in sale. Thanks so much for following. Until next time, Rob Kientz, goldsilverpros.com.